The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Lovely to see you all this morning. You're watching Squawk Box with Arabella Gamede and myself, Steve Sedgwick. And these are your headlines on a very busy day. The S&P 500 sees its best day since February. And the 10-year yield touches its lowest level since March as the Fed Chair Jerome Powell lines up the first rate cut for September.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Meta shares climbing 7% in extended trade after a beat on the top and bottom lines whilst issuing an upbeat outlook. The CEO, Mark Zuckerberg, espousing the benefits of AI on the call.
In the coming years, AI will be able to generate creative for advertisers as well, and will also be able to personalize it as people see it. Over the long term, advertisers will basically just be able to tell us a business objective and a budget, and we're going to go do the rest for them.
Qualcomm shares dip, and that's despite topping forecasts, while ARM shares plunge as the chip designer holds back on increasing its annual outlook amid weakness in some markets. And the Bank of England weighs up whether to cut rates for the first time since 2020. The decision seen on a knife edge. Don't miss our special coverage. The Bank of England's rates decision that's due at midday London time.
There's so many things from the headlines straight away. First of all, I had to check myself to check it was August. I'm not allowed to do pinch punch first of the month anymore. HR have stopped me. So
really?
yeah, apparently my co-anchors didn't like it. So we are in August, and it wasn't a momentous month of July. Secondly, can we get that still up again?
That's a great picture, Steve.
Oh, well, Sylvia looks magnificent. Who's that Burke next to her, that stupid gurning? Okay, of all the pictures, I've been in this place 24 years. Can they not find it?
Is there a decent picture of you like better? A better looking picture of you than that? I'm just asking. Is there?
The Federal Reserve held rates steady in the 5.25 to 5.5% range, but signaled it would be ready to cut at its meeting in September if inflation and the economy continue on their trajectory. The Fed will hold its next meeting just 7 weeks before the presidential election, with markets now pricing in a 100% chance of a cut. Isn't that extraordinary? And more than a 75% chance the Fed will pare back its benchmark rate by at least 75 basis points by the end of the year. Now, speaking to reporters after the decision, the Fed Chair Jerome Powell said a cut could be on the table at the next meeting.
We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Well, on the back of all of that, what happened to the market? Well, this is what happened, really. You just saw a rally actually come to the fore then. The last day then of July, and it was really a significant rally across the board, significant gains seen across these majors. Even the tech players, of course, we did look at the likes of Meta coming out with earnings after the market closed yesterday, and there was some trajectory upwards that you saw on the back of that then. But really, AMD even led the upside, around 7% higher as well for that share price. So significant moves there, 2.64% higher than for the NASDAQ composite. Just to give you some highlights on all of this actually as well then. That push wasn't enough, however, to avoid a July drop for the NASDAQ composite. It actually dropped down around 0.75% then in across the whole month of July. Major indices had not fallen in July since 2014. So the NASDAQ bucking that trend then for the first time. But you did see the Dow Jones Industrial manage to move up 4% then in the month of July. The Russell 2K, also interestingly enough, the outperformer across the board here, 10% higher in July. Again, showing you that that rotation really did happen. It was more than just a one-day event. It was actually a symptom for the whole month. But again, it was these big tech players that we continue to speak about, right? They're the ones that actually led the push higher than in yesterday's trading. You saw AMD manage to move up 4.3% by the close of trade. Nvidia having that 12.8% surge then on the back of AMD's uptick. Of course, those numbers out of AMD have been interesting. Nvidia hasn't even reported numbers yet. So we're going to zone in on that semiconductor play as well in just a bit, with Tesla continuing its upward tick as well of late. On to the Treasury picture here. Well, U.S. Treasury yields plummeted late then yesterday, particularly after Fed Chair Jerome Powell started to keep rates the same, yes, but he did make note that a September rate cut is on the table if inflation continues, of course, its trajectory as it is right now. That was the anticipation even before the decision was made then yesterday by the Fed. You're seeing the 10-year note then sit at 4.05. That is ultimately the lowest that we've seen it really since at least the last 4 months as well. So rather a whole host of questions will be asked on whether we will see that rate cut and how many rate cuts ahead as well. The 2-year note, 4.28. Very quickly here, your dollar crosses then soft this morning for the dollar. In fact, then after the Fed opened the door for that September rate cut, helping to keep the yen pretty much pinned then to its best level since March, strengthening even 0.9% in yesterday's trade alone. Then you did see Japan actually spend 5.53 trillion yen on FX intervention as well over the last 3 days or so in Japan. The yen surging 7% in the month of July, below 150 is where you're seeing it. Overall, here's your Asian market picture as well. Then you're actually seeing a decline across a lot of this market. Then the Nikkei 2.6% lower. So Hang Seng and Shanghai Composite actually started the day a little bit more positive. You're seeing the outlier of around 3% after the BOJ yesterday decided to raise interest rates, but that's eased off a little bit, 2.64% down though for this trading picture so far, Steve.
Super duper. Right, let's get another view on this with Erin Osman, who is Managing Director of Wealth Management at Arbuthnot Latham. Erin, it's your first time with us. Thank you so much indeed for joining us. And you got the early shift, unfortunately.
That's all right. Happy to be here. Thank you.
Good. Well, that's fantastic. Look, there are so many questions to ask you, and I know we can ask you about some stock stuff a little bit later on. So we'll have two chats. Let's focus firstly on the Federal Reserve. Beautifully orchestrated, beautifully managed. We all seem to be expecting this September cut now. The language was tweaked appropriately. Or am I missing something?
No, I think you're right. I think the language was a little bit more focused on let's get ready for September. There was a good few questions in the press conference that were, I think, quite appropriately pushing as to why not now. If we feel like we're on the right path to cut, the economy's in a good place. I think that's one of the things that Powell and the other members of the committee feel comfortable with, that they probably could go now, but they're willing just to hold things out a bit longer. I think the key thing for us was looking at the market's reaction and pricing perhaps 3 rate cuts by the end of the year. That probability increased as well.
The market has been stunningly wrong. I'm talking about the highest echelons of economics at the best investment banks have got it unambiguously wrong for a long time at the start of this process as well. Who's to say that any of them, I mean, because I'm sure when we get the cut in September, they're going to say this isn't necessarily the start of a prolonged process as well. You know, what's the language they're talking about today with the Bank of England? A reduction in restriction rather than a cut as well. We're going to have to get used to that. A reduction in restriction, and that is accurate though, isn't it, as well? So they're going to be at pains not to say this is the start of a big process. Yeah,
we're quite comfortably in restrictive territory right now, so it does take some movement to get out of there. And actually, I think as much as the market has appropriately priced in a full likelihood of a cut in September, again, Powell set out that there's a pathway where we could see 0 or as many as 3 by the end of the year. So whilst that's unlikely, I think the Fed is rightly being very data dependent from here before they make decisions to come in.
I mean, I was about to ask, because if he says 3 rate cuts, the meeting in November would be the day after the election.
Yeah.
I mean, that's That would be very interesting if he was to cut on a day like that. Does that mean that 2 cuts is pretty much his best options, really, when you consider that the Fed has usually just tried to play a more sort of, I suppose, unmoved hand when it comes to elections?
Yeah, look, I think Powell answered that question quite directly in yesterday's conference and was clear that they won't be influenced by political decisions. They've got a framework through which they'll make their decisions. I think if you were to perhaps put the political card on the table, it makes it more likely they do a November cut after the election than a September cut in the run-up to the election. We've already seen Trump out there making his views quite clear on what he thinks should be happening, and that does increase the risk if, or certainly of being lambasted on social media by Trump. I think the Fed will remain robust, work to their framework, and provided they see further progress in the inflation picture, in the jobs market, we'll see a cut in September, and potentially, provided that path remains, as they project, another 1 or 2 for the year.
Aaron, there's no doubt that the consumer offers a significant push to GDP across the United States, right? And softer spending by consumers, as you're seeing it in the likes of McDonald's, the likes of Starbucks as well. At what point do trends like that start becoming a risk factor that the Fed has to start considering?
Yeah, I think it's a really good question. I think the one area that we have some concern about is the consumer in the US and the risk that the jobs market falls away more quickly now. I think many commentators have been surprised that the pace of unemployment rising over the past few months now, or really over the last year, has been much slower than you'd normally see. And there's a risk that that accelerates from here, but provided you see a continued steady increase in unemployment or potentially holding around these levels, then I think that the consumer's still got enough out there with real wage growth to support spending at a sufficient level. We're talking about the US cooling to kind of a 1.5–2% growth rate rather than maintaining a higher rate than that, and I think that's comfortable.
Great chart on the screen that the team have put up on the dollar-yen, dollar index over the last 5 years. And apart from that spike in the middle of 2022, if you look afterwards, it's been so solid, such a tight range for a couple of years. Is the market pricing in the various carry trades, various interest rate differentials, various interest rate movements potentially accurately, or do you think actually the dollar is set for a period of weakness, as many have called about? How do you feel about the currency situation at the moment?
Yeah, I think currencies is possibly a bit more difficult of a position to call right now.
Yeah.
There's a lot of talk about the carry trade being over on dollar yen, with the big surprise yesterday from Bank of Japan.
So let me get this right. We've got one at 5.37 and one at 0.25 now, and the carry trade's over.
I think there's still a bit of juice, right?
It seems a bit premature.
We've seen dollar yen move from about 160 to 150 over the past few weeks. So there's clearly some market participants that thinking that the yen got further away than it should have done. We think that the relative strength of the US economy provides the Fed with the comfort to cut rates at a slower pace, and therefore the interest rate differential is probably in the favour of the dollar remaining at least stable, if not stronger, in the medium term.
Right, superb. So we've covered the macro and we've covered the Fed. We're going to talk about a little bit about technology stocks in a short while as well. But thank you, Aaron. That's really great. Aaron Osman, Managing Director at Wealth Management at Arbuthnot Latham, will stay with us for a little bit longer as well. Right, so let's move on to Societe Generale. Posted a beat on the top and bottom lines in the second quarter, with net income surging almost a quarter on the year to come in at 1.1 billion euros. But the lender flagged it now expects French net interest income to come in lower this year than previously expected. And we've also had numbers out from AB InBev.
Yeah, certainly, Steve. I mean, we've already spoken to the CEOs of Diageo, even Heineken as well, and that volume story has been one to look out for. And of course, the conversation around premiumization, whether that's still in play then. Just really with regards to these numbers, revenue coming in at 15.3 billion US dollars then for the Q2 revenue figure, while adjusted EBITDA, that margin then sitting at 34.6%. Gross profit then $8.5 billion US dollars for the second quarter here. The company saying that they expect their EBITDA to grow in line with their medium-term outlook of between 4 to 8% then. Also saying then that they expect the normalized ETR in full year to be in the range of 27 to 29%, also expecting net capital expenditure of between 4 and 4.5 billion US dollars in the full year for 2024. Quick look at those share price then, of course, which this year has gone down actually 6%. So some pressure coming through then on AB InBev's numbers. Of course, the question marks around, yes, inflation, but also the cost of living and how much people are able to afford having those drinks as well. Now, coming up on the show, Meta shares a pop after hours as a strong bump in ad revenue helps offset surging AI costs. Plus, auto earnings are in focus. We'll be breaking down the latest numbers out of BMW as well as Volkswagen. That happens at 7:30 CET. And we'll hear then from the VW CFO. That's later this morning. Also on deck, Shell earnings. We'll break the results and hear from the CEO, Wael Sawan. That happens at 8:25 CET. Stay tuned. It's a first on CNBC.
Ambition to me is about doing better.
I think ambition creates a pathway.
Best advice I can give someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters, and global business leaders on CNBC.com.
Welcome back. Meta shares surged and extended trade. It must be because of all of they've done well in the metaverse. I'm sure that's what it is. Extended trade after the tech giant beat expectations for its second quarter revenue and profit and issued a better than expected forecast for the current period. The company posted $39 billion in revenue, up 22% compared to a year before, as it continued to benefit from growth in the digital ad space. I'm sure it was also about the metaverse. Can't not have been, can it? I jest. But the tech giant is also facing higher expense amid growing interest in AI. Oh, and the metaverse. There we go. CEO Mark Zuckerberg said the company had huge ambitions in artificial intelligence.
I do think that part of what's so fundamental about AI is it's going to end up affecting almost every product that we have in some way. It will improve the existing ones and will make a whole lot of new ones possible. So it's it's why there are all the jokes about how all the tech CEOs get on these earnings calls and just talk about AI the whole time. It's because it's actually super exciting and it's going to change all these different things over multiple time horizons.
Well, we're all around the set still. We've got Aaron still with us as well. We've got Arabile. Oh, hello, mate.
Good morning.
I know I'm being silly about this, but it is a very important point that everyone loves the next big thing. Funny enough, I was talking about NFT investment with an old mate of mine yesterday as well, and that went well. Not. But the point being, metaverse was the big shiny thing. Now AI is the big shiny thing. But he's still sticking with the metaverse, but he's still losing vast amounts of money in the metaverse. And the market doesn't care about the metaverse, when all it did care was about the metaverse. And it just is a metaphor for me for this industry, which has the next big shiny thing until it doesn't.
Yeah, there was this huge thing with Meta and the metaverse where it sort of came out with this big play, this big pivot, changed the whole name.
All anyone cared about.
And it's all anyone cared about. And then they were losing a ton of money every quarter. They lost $4.5 billion in the last quarter, and the market was very upset.
This last quarter, they lost another
$4.5 billion.
The market doesn't care anymore.
But the narrative has changed. This is the key, right? I mean, one of the things, ultimately, Meta, even after the pivot to the metaverse, has been, is, and will continue for the near term to be at its core an advertising business. And that's what we saw. With the metaverse pivot, it was all about that. There was too much focus management on the metaverse. They were losing a ton of money. The advertising business was under pressure. And all of a sudden, the ad business came back. They brought out some new products. They have actually, what looks like successfully been using AI, not so much in terms of the consumer facing, but more on the back end to improve some of the efficiencies around their ad software. And that's why you're seeing sort of 22% growth delivered in that ad business from Meta. And so the narrative switches about the few things we've been speaking about this earnings season is market wanting growth, well above expectations, market wanting to see cost control, and market wanting to see investment for the future.
But not too much investment,
but not too much
in case, because you've got to keep it. It's very Goldilocks. It's very Three Bears. Isn't it
is, and that's what Meta actually managed to deliver in many respects. Very strong growth, way ahead of the market. CapEx projection for this year hasn't changed, even though it's going to increase next year. But the fact that it's investing heavily and continues to see that investment in AI and some benefits from AI, checked all three boxes.
I know everybody wants to come in. We'll talk about it later on, but I just want to get through these next couple of reads and then bring Erin in as well. Qualcomm beat Wall Street expectations for its EPS and sales and issued a strong guidance for its current quarter, expecting sales of up to $10.3 billion. Shares of the chip maker rose more than 7% at one point in after-hours trade, but the stock has since lost a little bit of ground. ARM shares declined. Wow, look at that, 10.5% in extended trade after the chipmaker disappointed on its earnings guidance. For the current quarter and the full year, the British firm, with the US listing of course, expects adjusted earnings in the second quarter between 23 and 27 cents per share, implying no growth at the middle of that range. No growth, wow. ARM also said it will be shifting its focus to lower volume markets such as data centers, adding the number of chips reported as shipped will be less representative of its actual performance. Wow. Our US colleagues will be speaking to René Haas, the CEO, 1600 Central European time. The reason I'm rushing on, because I want to get Erin's view on the semiconductors as well. Erin Osman still with us from Arbuthnot Latham. And were you invited to get involved in this one by the team? Oh, you were? Okay, I forget what they're up to. You know what Michael's like. Anyway, Erin, picks and shovels. Everyone loves a picks and shovel at the moment. They are oscillating concerns about AI, but they love the sellers of picks and shovels. Or actually, are people beginning to worry now about the scale of the volume growth?
No, I think it's absolutely about picks and shovels here. Microsoft, in their results, absolutely said that they are seeing the demand there, though. And I agree with Mark Zuckerberg. They will see the return on their investments, but for the hyperscalers it feels a bit more like an arms race almost, just literally spending to get there, and they can't afford to be the one that's left behind, so they have to spend the money there, and the amounts they're looking to spend is absolutely enormous, and as we just said, that's going to increase next year as well, and likely the year after, and the companies that are benefiting from this are completely within the supply chain of the semiconductor space, so all the way out from Taiwan, Netherlands and the US, there's key players within that space.
It does feel like the market's being a little bit more discerning, though. It's not all chips, no matter what they do. It's sort of, you look at companies, of course, like Nvidia, AMD, which are seeing great success, but then you look at Qualcomm and ARM's earnings and you see that actually, these are still companies that rely quite heavily on the smartphone market, which is still a little bit cautious. Samsung, we heard report, that's the memory side of the equation, that's in a recovery. So just from your point of view, is the market looking at the sort of semiconductor space now with a little bit more of a discerning view rather than sort of chips all go up?
Yeah, I think that's fair, and I think there's some valuations of companies within the chip space that absolutely got ahead of themselves, but I think those that are most tightly tied to the AI story, I think have that growth ahead of them. Where we saw the likes of ARM fall yesterday, they're so tightly tied to the mobile space, which has really kind of seen a bit of a stalling cycle this time round. I expect it will come back for them. Once we've got these new AI chips within phones, you'll probably see another good up cycle there, and that will support them. But our focus really, I think, is in the semiconductor space, supporting the AI rollout. Nvidia is without question the main player there. And although AMD's got a foot in the door, it's a fairly small one right now.
Aaron, just a very quick one. I mean, supply shortages becomes the big issue at play for some of these, players as well. Then does that continue long term, and is that then how you view the stock and think, well, if that's going to continue, there'll continue to be demand, and that is why you stay in the stock as well for a little bit longer? I mean, obviously not specific stock focus for you.
Yeah. So in order to train up these AI models, that they need more and more compute, and the number of GPUs we're seeing going into the data centers to support their need is increasing at an incredible rate, and we've seen tens of thousands, an increase in, according to NVIDIA, over 100,000 GPU data centers. That will increase at a continued rate. There's going to be more of those data centers rolled out. We've got NVIDIA rolling out the Blackwell chips coming soon, so you'll see another upgrade cycle there in due course. And all of the big tech names are on their customer list to buy into that down the line as well. So I think concerns of oversupply within the chip space are probably overdone at this stage.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Gumete, weekdays on CNBC.